everyone. Welcome to the show. I'm your host, Megan Henricks. Are you worried about the fate of your portfolio should a recession strike in 2023? If so, you're not alone. There's plenty of concern going around. You might feel tempted to sell your investments and stash your money under a mattress. But before you do, consider just how costly that decision could be. An analysis by JP Morgan Asset Management found everyday investors earned just half the average annual return of the S&P 500 index between 2012 and 2021. One reason for this huge performance gap was poor decision making during times of crisis. For example, the average investor often sold their investments during recessions after the market had already declined. Then they waited too long to reinvest and missed out on much of the recovery. It's a shame because they could have enjoyed sparkling returns by staying invested. The S&P 500 rallied 101% from the lows of the dot-com bubble in 2001 to the peak in October 2007. It surged 401% from the depths of the financial crisis in 2008 to the peaks in February 2020. And it rocketed 114% from the pandemic lows in March 2020 to the highs in January 2022. Of course, past performance is no guarantee of future returns, but history suggests there can be significant wealth building opportunities coming out of recessions. And today, we're going to hear how one seasoned investor seeks to capitalize on them. Joining us is Charles Edgar Martin, Senior Portfolio Manager at TD Wealth. Charles, thanks for being here with us.
Good to be here, Megan.
Charles, you've experienced three recessions in your career. How would you say the way you handled your first one compares to how you'd handle one today?
Yeah, that's a good question. Um, my first one was 2000, but I'll go back a little bit earlier. The first big drop in the market I saw was 1998, and I remember really being terrified. To be quite honest, I was on my honeymoon, and I remember being fearful that I would have no job when I came back. And then things came back really quickly, and I was shocked how quickly things came back because I thought I might have to make a career change. And all of a sudden, things were okay. And then 2 years later, we had a recession. It was a doozy, that technology crash that came along with it. And the 1998 drop made me a bit more comfortable going through 2000. Already, I had read this in my studies that things come back, but having lived it once made me a bit more of a believer. And I decided that I would have a process going into this one. So I built my process. 2008 came. That was a really big recession, the biggest of my life probably. But I was really confident because I'd been through two drawdowns, one recession and one scary period. I had a process. I just knew that I had to apply my process and we'd come out okay. And then 2020 came, which was, very unique in a lot of ways, but I really was not fearful at all. So I feel like the next one, I've lived it uh, three times already. I'm not fearful that there'll be anything you know overtly bad. I know that if I follow my process, things are going to be okay.
Now, before we get into our conversation, I have a trivia question for our audience. The S&P 500 index has hit a bottom during US recessions 13 times since 1929. How many months on average has it taken the index to reach that bottom before starting its recovery? We'll reveal the answer at the end of our conversation, so stay tuned. Now, I mentioned earlier in the introduction, recessions can be opportunities for investors to build wealth. What are some of the ways that investors might take advantage of a downturn and benefit over the long term?
Stock markets are expected to go up and down. Yet, and we all know this going in, but every time the market goes down, we freak out a little bit and say, "Oh my goodness, what's going on?" And we think it's like the first time, and the reasons that it's happening are the first time it's ever gone down for this reason, and it seems a little more scary. In fact, if someone told you that the stock market averaged a rate of return of, let's call it 9% a year over the last 100 years or so, And you knew that it wasn't going to climb in a straight line 9% per year, or 1/12 of 9% per month. um, and you were in the accumulation phase, let's say, of your life, where you're saving for your retirement one day. Well, the periods where it goes down, where the rate of return is lower than that average 9%, are periods where you're going to be buying at lower prices, right? And if you know you're going to average 9% over the next 20 years, and the first year is minus 10%, well, to average 9% over 30 years, the next 29 years, the rate of return will be above 9%, right? So, in fact, investing or sticking to your plan in that year one, where your rate of return is lower than the average expected rate of return, is where you're going to get the biggest bang for your buck. So, when you ask, are there opportunities in market declines? Absolutely. As long as you're in the kind of things that don't go down permanently. If you're in the kind of investments that do have an expected rate of return that is, going to be positive, buying in the negative years usually means you're going to increase the rate of return on those investments.
And yet, investors, like we mentioned in the introduction, tend to underperform that broader market return on average, especially during recessions. So, how can investors be their own worst enemies during these times of uncertainty?
I think we have to realize that we're human beings, and human beings are emotional creatures. So, as logical as we want to be, our instincts are to be emotional. So I think we have to be aware of these traps, because emotions in investing are your enemy. Some of the things are overconfidence. We sometimes can be overconfident in our conclusions. I remember some people during the COVID meltdown saying, "Oh, this COVID thing is going to be huge, and investments will never come back." And believe me, I know the science. I'm a scientist, and we will never recover. And so they were overconfident, obviously, because a few years later, we've moved on, not completely, but the markets have moved on, and COVID is no longer the theme of the day. Mental accounting is another one. People, for whatever reason, we remember the price we pay for a stock, and we never forget that price. And sometimes we refuse to sell until we come back to that break even level, which is really just, it makes no sense whatsoever. And there's also, the fear of regret or missing out. We've seen a lot of that in the past. I think you can boil most of these down really to fear and greed. Fear and greed are really our biggest enemies in investing.
If we were to kind of put this all together, what are some of the common mistakes that investors tend to make, especially during recessions, because of these cognitive biases?
Some of the most common mistakes that I can think of, I guess, not sticking to an investment plan. I mean, I back up and say a lot of people don't make an investment plan. First of all, please make an investment plan. I have one for myself. How are you going to achieve your goal? What is your goal, first of all? How are you going to achieve it? How much are you going to save per year? How much is that going to be per month? What is the level of risk that you're going to take in your portfolio? These are things that have to be addressed in your investment plan. So when a recession comes, does that mean I change the plan? Because I see a lot of people do that. They say, whoa, there's a recession here, plan no longer works. Well, if the plan was built properly, it really took into considerations that there would be bad times, because the economy is cyclical. Another mistake I see often, it's kind of related to what I was just saying, but panic selling. We definitely see that a lot. And the feeling that I hear, or the way it's expressed to me a lot of times, is, Charles, I hear what you're saying. Things will be okay. I understand, but you know what? I'm just to be safe. I'm going to sell my investments now. And when things calm down, if you're right, and you probably are going to be right, things will calm down. Then we'll go back in. It sounds like a really reasonable strategy, but when you think of it, if you're selling your investments in times of uncertainty, you're selling at a certain price. And your plan is to buy back when people are really calm and positive and optimistic about the economy. Do you think you're buying back lower, same price, or higher? If you're selling in uncertainty, buying in positivity, you are selling low and buying high. You follow that strategy, you are guaranteeing yourself loss. So you do that one or two times, and you will cause major, major damage to your portfolio. Because as you mentioned earlier, typically the rates of return 1 year out from really bad times are usually really high. We're not talking 1 or 2% above average. We're talking significantly above average. And if you're not there for that, it really hurts the portfolio long term. Another thing that people have to remember is, they'll say, well, maybe I'm going to try to get out when there's a recession and get back in when things are better. So if a technical recession, or the technical definition for recession, is two negative quarters of GDP growth in a row. So let's say, the first and second quarter of 2023 are negative quarters. Well, that would be identified sometime in the third quarter, right? So you would know there's a recession that began January, sometime in July or August. So how are you going to go back in January and sell? You can't, right? So you're going to only know when there's a recession after the fact, that it's already begun and it's several months in. And not only that, the stock market is what we call leading indicator. So it tends to start going down several months before the beginning of a recession. It also does on the upside. Typically, the stock market starts rising several months before the economy begins to rise. So when times are worse, the economy's left its bottom usually several months behind. Um, and timing the market, this is, I see a lot of people trying to time the market. And these people, I would say, are not necessarily fearful of the market. They kind of get that the economy is cyclical, but I think it's more of a greed thing. They say, okay, I know it's coming back, but I think if I sell now, I can buy back in 3 or 4 months at a much lower price. And I know there's a temptation to try that. And I've seen so many people try to do it. And you have to be right twice, first of all, right? If you're right on the sell, good for you, great. But you got to be right on the sell, on the buy too. Because if you're right on the sell and wrong on the buy, you've lost money. Um, and I just don't think there's any evidence that people are able to do this consistently. So you can really damage your portfolio returns.
And actually, just a quick note to our audience that Charles discussed more of these cognitive biases and mistakes investors tend to make in his earlier webinar, 5 Common Investing Mistakes I've Seen in My Career. So check it out in the Learning Center on Webroker and on TD's YouTube page if you'd like to learn more about it. So we mentioned earlier that we've been through the ups and downs of recessions before. What's your mindset as an investor when it seems as though a recession could be near?
First of all, when I buy equities, I'm buying for the long term. So the bar is really high as far as the quality of company I'm buying. So you buy companies that will be able to withstand recessions, because the likelihood of a recession in a 10-year period is pretty high, right? I like to buy companies that are leaders in their industry. I like to be in industries that I feel are needed in good and bad times. I like to buy companies that are not overly indebted, because you can have a great company, that, if they have too much debt, can go bankrupt, right? Because if there's a couple of bad months or quarters or years, well, it's good to have some cash reserves, or let's just say a balance sheet that's healthy, so you can borrow money to help you get out of those bad times. I look at the companies, every day, and I ask myself, would I buy this company today at the price it is today, with everything that I know about it today, not when I bought it? Because again, the price I paid is not important. And if the answer is no, that I wouldn't buy it today, then I have to ask myself, why am I holding it? And the reasons I wouldn't buy it today could be that the environment has changed. It could be that the company is a lot weaker than I perceived it. It could be that they increased their debt level too much. It could be that there's a special change in their industry that I couldn't have known then or didn't know. But all of those are good reasons to not buy or to sell. It could be also that the price went up too high. What if I thought I would quadruple my money in 10 years, but I doubled it in 1 year? Um, Maybe from this price, it no longer makes much sense to keep it. And in a recession, I look for opportunities. So if I feel that the companies that I have are no longer as stable or as solid as they were, then I will get rid of them, and replace them with companies that I think are more solid. I always have a watch list, so I'm always looking at several companies that I think are great companies, and usually I'm not buying them because their price is too high, um, or I'm just waiting on something. Maybe I'm waiting for a little bit more data to get more conviction in the idea. But sometimes I see opportunities where a company that I like has gone down, but there's a company I find just as good as the one I have in my portfolio, but it has gone down more. And sometimes that's a good opportunity for a switch. Those switch opportunities are usually very, very quick, because the markets tend to move very quickly in those down days and months. And those opportunities, I think you have to have that watch list ready to go, and have your eyes open on what you want to buy and what has to happen, and act quickly when it does. So that's the way I do it. And
What I like about what you answered is I think a lot of times when you get financial considerations, it's always about staying invested, just hold on to it. But I think there are times when reevaluating to see if this makes sense or not, and that sometimes the decision is to sell, can really be helpful to some of us that when the time comes, we're not sure whether to make that switch or not. All right, you've experienced three major recessions during your career. So let's explore your approach to investing through them. What's the first thing you do when you feel as though we may be in a recession?
first of all, I want to get the flavor of the recession. Every recession is different, and you can never perfectly anticipate every aspect of the recession. So as it is happening, I really want to figure out what are the main themes of this recession, and where does the danger lie, and am I still as confident with the holdings I have? So I do an enormous amount of reading in times like that. Um, we have to be careful because early in my career, the information was harder to come by, but the source of information, I would say, were a little bit more reliable. News has really become more of an entertainment thing, and I feel there's definitely a negative bias. Where I like to get my information, the central bank websites, really good. The Bank of Canada, the Federal Reserve have excellent websites with tons of data projections. The Federal Reserve puts out their projections every 3 months now, and there's so much information in there, that it's extremely useful. So I like that. I like the Bank of Canada's website. Also, the banks. I mean, if you look at TD Economics, we have really a lot of very good information in that part of our website, and certainly the other banks in Canada and the U.S. Have that kind of information available. So I like to get a lot of information. I like to do a lot of reading.
You've talked a lot about looking to identify companies that you feel can thrive through a recession and ultimately come out stronger. What are some of the metrics you consider to help you spot these opportunities?
First and foremost, for companies that are growing their revenues. Then I'll look at earnings. Now, earnings, there's all the costs that are deducted, and that's where the creativity can come into effect. So sometimes you have companies that are growing their earnings, but their revenues are not growing. That's not interesting for me. And I really want to make sure those earnings are clean. So I like to look at the cash flow. Cash flow is a number that's harder to cheat on, in my opinion, than earnings. There are more stringent rules on what you can use for cash flow. So I look for cash flow growth again. And I'm looking for the cash flow yield. Okay, so to know the price, I have to see what that cash flow is, relative to the price I'm paying, to see if it makes sense. I want to have a rate of return, so that the money that I'm getting back as a shareholder makes sense for the price I'm paying. Then I'll look at the risk side of the equation, and I want to make sure that the level of debt is manageable, because if you have a great company that has so much debt that they can endure a few bad months, well, you've got a company that's very has a strong possibility of going bankrupt one day. So I want to make sure the level of debt is manageable. So yes, what I would say is I'm looking. You can kind of break that down into three things. I'm looking for growth. I'm looking for a price that makes sense relative to the earnings and the cash flow. and I'm looking for a balance sheet that is solid to carry them through rougher times.
So another note for our audience, we cover the historical performance of different asset classes under various market conditions in our webinar, How to Help Prepare Your Portfolio for a Recession. Once again, it's available on demand in the Learning Center and on our YouTube page. Okay, Charles, I have a question for you. What helps you determine if a stock is overvalued?
Right. So it's not just about finding good companies that have good balance sheets, right? It's about paying the right price. And, in that growth at a reasonable price, there's that reasonable price part. So really, it's a percentage of the cash flow relative to the price is very important. And what is the right percentage? It kind of depends what you want to make, what the interest rate environment is. Because if I can get a guaranteed bond at 20%, like I could in 1981, why would I buy a risky investment that could give me 10, right? So if the interest rate is high, well, the amount that I want to earn as a cash flow yield has to be higher. If the interest rate or the risk-free rate is low, then the cash flow yield that I will be willing to accept as a good price is lower.
Thanks for highlighting some of the fundamental metrics you consider when investing, Charles. Now, I wanted to take a moment to hop into WebBroker to show our viewers how they can track down investment opportunities during a recession using some of the considerations you've mentioned. So once you log into WebBroker, you can use our main menu and click Research. From there, we're going to go under Tools and we're going to find Screeners. Then we're going to switch from Discover to Screening. From here, because we already have a set of specific criteria that we know we want to plug in, what we're actually going to do is clear all of the existing criteria. So we'll go to the right and we're going to click on Clear All. From here, what we're going to do is under Exchange, we're going to click on the drop down and select Canada. And then we're going to add more criteria. First thing we might want to do is under Company Basics, we're going to go to Market Capitalization. From here, you're going to see that we can toggle from a minimum to maximum, and on the right, it's going to give a brief description of what this criteria means. So for this one, we're going to set our minimum to 1 billion, so we can just put a 1B, and we'll leave our upper point to maximum. We currently have 352 matches. Let's add some more. So now what we're going to do is we're going to go under fundamentals, which is to our right, and then we're going to select EPS growth 5-year historical, which is going to be under growth and earnings. From here, just like before, we can either move the sliding bar or put in a minimum maximum. For this one, let's keep our upper point to maximum and our lower point, let's change it from minimum and let's set it to 0. Which drops our matches down to 171. Let's keep adding. This time, we're going to stay under fundamentals, but we're going to go under debt, and we're going to find debt to capital ratio. Let's set our maximum to 0.5. Now we're down to 111 matches, so we're getting closer. Let's keep adding. This time, let's go under trading. And under volume, we're going to click on percentage change from 52-week high. And let's set our maximum to negative 20%. We're now down to 29 matches. I think we have room for one more. And this time we're going to go under valuation and we're going to click on price to earnings. And let's set our maximum to 20 as an example. Good. So we're now down to 24 matches. And from here, if we scroll lower, we get to see the results. And what's nice is that the system will already rank it for you. Well, this was our web broker demonstration. I hope that you found it useful. Thank you. Some asset classes and sectors may perform better or worse during a recession. That could potentially throw off an investor's desired asset allocation. How do you consider asset allocation when investing during a recession?
Yeah, so I guess if I simplify the world, and this is really an oversimplification, but you could say there are two approaches to asset allocation. There's tactical asset allocation and what we call strategic asset allocation. So tactical would be I will overrate the asset classes that I feel will perform best in this environment. And strategic would be I'm going to pick the asset allocation which goes well with my temperament and my goals, my risk tolerance, and then stick to it. So I believe strategic asset allocation is the better approach. It's what I use for myself, for all my clients. I believe that our ability to choose which asset class will do best in the next 12 months is really not that high. So to try to do that is less safe, let's say, than a strategic asset allocation. So in the bad times, in the periods where the stocks go down, a strategic asset allocator would rebalance their account. I mean, they would realize that they would no longer be 50-50. They would maybe be 60% fixed income, 40% equity. And the rebalancing of the account to the strategic asset allocation would require you to sell 10% in fixed income and to add that to the stocks. Conversely, after several years of stocks doing better than bonds, you'd have the opposite, and you'd be to stick with the plan, you'd be forced to rebalance by selling some stocks and buying bonds. So that strategy keeps you. It's kind of forcing you to take profits when stocks have done well, and to average down when they've done badly. So I like that. So I find the strategic asset allocation works really well. It's if it's done with a mindful long-term outlook, and if you rebalance, if you have the discipline to rebalance it properly.
And I think to add to that is that sometimes for investors is that it's difficult to have to sell their investments that are doing well to buy back the ones that are not doing so well. And I think this kind of comes into play of another thing that can be challenging for investors will be their hesitancy to invest a large amount of money into an uncertain market all at once. So, what's your approach to managing the risk of buying investments during a recession? Should we put all our money in at once or should we think of something else to do?
Most of the time, I like to dollar cost average that into the market. So for me, 5% or more of your net worth is big enough to have this consideration. If we're talking about 4% of your net worth, for me, I would just invest it right away because most of the time markets go up, and most of the time keeping that money on the sideline will not be a good thing. Now, if we have 10% of your net worth come in all in one shot, the ramifications of investing it at a bad time can be really serious. So in that case, I would average in. Let's say if it's 10%, maybe we divide that by six, and we say every month we put 1/6 to work, and we stick to that plan. The only time we don't stick to it is if, in my case, is if the market goes down a lot, then we maybe accelerate it. We don't slow it down. A lot of people If the market drops an awful lot, they say, whoa, whoa, let's stop. For me, it's the opposite. Let's double up. Let's take 2 months instead of 1 month of investments. And sometimes that'll be a 12-month period. Sometimes it'll be an 18-month period. But generally, I'm invested in under 12 months. Large amounts get invested. So my experience is, when the markets drop an awful lot, and 2008 certainly is reminiscent of that. If you actually, take a graph of 2008, 2009 and really focus in on it, you'll see it was really devastating for 1 month. But most of the other period was not that. It was really down for a month. The rest was not as bad. It's quite impressive how fast the stock markets came back. And what's surprising is that that's not surprising. That's kind of how it's happened in the past.
No, it definitely is. I'm actually glad that you brought it up because I think, again, when you're in it, you don't see that you're going to recover. It's almost like that recency bias where if it's been sunny the last few days, you think it's just going to continue to be sunny. So I think when we're in that recession where everything's down, it's hard for us to think like this will recover eventually. So that's a really good point that you added. Well, thank you so much, Charles. But we're going to have to leave our conversation there. Thank you again for sharing your perspective on investing through recessions and your process for evaluating investment opportunities during uncertain times. Now, before we wrap things up, let's reveal the answer to our trivia question. As a refresher, the question was, the S&P 500 index has hit a bottom during US recessions 13 times since 1929. How many months on average has it taken the index to reach that bottom before starting its recovery? So, the answer is an analysis by Schroeder's Economics Group found the S&P 500 index bottomed out after 8 months on average during a recession. What's more, it took just 5 months on average from the time the bottom was reached to the end of the recession. Does that surprise you, Charles?
So in my mind, I was thinking 9 months, but I had no idea if I was right or wrong. But I thought if I was wrong, my period was probably too short. So I'm surprised that it's 8 months. Isn't that
Yeah.
amazing?
It is. It's
It's
pretty good.
incredible.
Again, it helps us to like calm down to realize, okay, this recession is going to be, again, historically speaking, limited, and then we can again benefit from the recovery. So thanks again for joining us, Charles. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time.